We just finished going through Coherent's fiscal 2026 fourth quarter earnings call materials, and now we want to share our takeaways with you. Fourth quarter earnings per share up 74%, full year up 59%. Go ahead and read those two numbers again. I'll be honest with you, I came off this call a little wired, because that is not a normal print. But here's the thing, and I want to say it before we get rolling. Neither of those numbers is the reason to own this stock, or the reason to walk away from it. This company just handed Wall Street a completely different question to argue about. Let's go find it. The company said it about as bluntly as any management team ever says it on an earnings call. The demand question is over, and revenue for the next year is strictly dictated by the factory ramp curve. Sit with that a second, because it is a strange thing to brag about. What they are telling you is that every single product line is supply constrained right now. They are not fighting for orders. They are fighting their own factories. The company also stated that full-year earnings per share rose 59% and the fourth quarter alone rose 74%. Here is our read, and this is us talking, not them. When a business is demand limited, you value it on the market. When it is supply limited, you value it on the plant. That is a completely different exercise and honestly a harsher one. A demand story can be wrong for 2 years and still come good in the end. A ramp curve either lands on schedule or it does not, and you find out every 90 days. Here is the piece most people miss when they look at this name. Coherent does not sell one slice of the optical stack. According to the deck, it sells the entire light path. It grows the compound semiconductor wafer, builds the laser, assembles the 800G and 1.6T transceiver module. Then it pushes further into optical circuit switching and further still into putting light right next to the silicon. The company stated it is the largest US transceiver supplier with more than 20 manufacturing facilities in the United States. And 79% of fourth quarter revenue came from data center and communications. Think about what that vertical integration actually buys you. Everybody else has to go shopping for lasers. This company walks down its own hallway. Our take is that in a shortage, whoever owns the scarce input does not just win on margin. He gets to decide who else is even allowed to compete. That is the real asset here, and it does not show up as a line item anywhere. Quick word before we keep going. What Radar actually trades through is interactive brokers. One account reaches the US, Japan, and the other majors, which matters when you are chasing a supply chain across 3 countries. The link is in the description. Being straight with you, this is a paid promotion. We are a customer, and they pay per click. Not investment advice. Investing carries risk. Do your own homework. Alright, back to it. This is the page I would pin to the wall. The deck lays out a wall it calls power and distance, and copper runs straight into it. The company's framing is that connecting tens of thousands of GPUs is something copper physically cannot do. Not expensive, not inefficient. Cannot. Past that wall, 3 optical markets open up, and the deck puts a size on each one. Scale across the multi-rail piece more than $2 billion by 2030. Scale out optical circuit switching more than $4 billion. Scale up optics moved onto the package itself more than $15 billion. Now the line that matters most on this page is the small one tucked in the corner. The company calls this an architectural mandate, not a business cycle. Our read is that if that framing holds, the usual optics playbook of boom, glut, price war does not apply the same way. And if it does not hold, then everything else in this deck is just a very good cycle wearing a nicer suit. Now the numbers, and watch how they accelerate as you walk down the page. The company reported revenue of $7.12 billion, up 20-30%. Gross profit up about 28%. Operating income up about 42%, with operating margin adding 300 basis points to 20.5%. And non-GAAP earnings per share of $5.61, up 59%. Do the math yourself. Every step down the income statement, the growth rate gets bigger. 23, then 28, then 42, then 59. That is what operating leverage looks like when it is actually working. There is one more line down in the corner that I think got badly underplayed. The company's stated debt leverage was crushed from 2.0 times down to 0.7 times, with $530 million repaid. That is the boring line. It is also the one that turns a bad quarter into an annoyance instead of an emergency. A reasonable read is that they cleaned up the balance sheet right before the heaviest spending years show up. That is not luck. That is sequencing. This is my favorite kind of chart because it shows you where the money is going. The company reported gross margin expanding 660 basis points across 8 of the last 9 quarters. Underneath that, 2 lines moving in opposite directions. Selling and administrative dropped from 10.3% down to 8.2%, a cut of 2.1 points. Research and development went the other way, up from 9.8% to 10.2%. Total operating expenses landed at 18%, and the company guided below 18% for the first quarter of fiscal 27. Pay attention to the shape of that. They squeezed the overhead and they fed the lab. Plenty of companies hit a margin target by quietly starving research, and you do not find out for 3 years. The company says the expansion came from lower input costs, better 6-inch wafer yields, and optimized pricing, not from cutting the future. Our take is that this is the most encouraging page in the whole deck and the easiest one to flip straight past. Here is the data on where the growth is actually coming from. Data center and communications is 79% of revenue, up 19% sequentially and up 59% year over year. Breakout data center on its own, and the company reported it grew 66% year over year, with consecutive double-digit sequential quarters. The other 21% is industrial, which the company described as roughly flat on a pro forma basis. Semiconductor and display growth got offset by broad market weakness. So let's call this what it is. Right now, this is an AI data center stock wearing a diversified company's clothes. And I want to give you both readings honestly, because this cuts two ways. The bulls would say industrial has not even started helping yet, so there is a second engine sitting idle. The bears would push back that when 79% of revenue rides one build-out, diversification on paper protects nobody. Both of those are true. Which one matters depends entirely on whether AI CapEx has a bad year. If you only remember one page from this deck, make it this one, because it names the choke point. The company stated that assembly and testing are not constrained. The limit is raw laser production, specifically indium phosphide lasers. That is the whole ball game. Picture a restaurant with a line out the door and one cook who can only move so fast. The dining room is not the problem. The kitchen is. Then management did something I almost never see. They gave a number you can actually check. The company said June laser output rose 80% and that it translates into first quarter data center growth above 80%. That is a rare, highly precise commitment, and it can be directly audited in 90 days. Here is my honest confidence read. I may be 75% that they hit it, and that is not because I doubt the demand. It is because the equation only works if nothing in that fab hiccups. Management just handed all of us a scoreboard. We should use it. This page explains how the choke point gets opened, and it is a physics answer, not a hiring answer. The company is moving from 3-inch wafers to 6-inch, and the deck puts the result at 4 times the output at roughly half the cost structure. Then it gives a schedule, which I appreciate more than I can tell you. Internal output doubles in the first quarter of fiscal 27, and the company says that it's ahead of schedule. The Zurich Phase 3 facility comes online in the first half of 2027, and by the end of 2027, output doubles again, with the company stating the substrates are already locked. The deck is careful to say the gross margin lift comes primarily from cost structure, with yields on CW lasers, EML and photodiodes improving on top of it. Our read is that this is the difference between a shortage that ends and a shortage that ends profitably. 4 times the units at half the cost is not a capacity story. That is a margin story wearing a hard hat. Now here is the part that reframes the whole valuation, and the deck says it right at the top. None of what is on this page sits inside the current $7.12 billion run rate. None of it. Optical circuit switching starts in fiscal 2027, with a market the company puts above $4 billion. Co-packaged optics and photon link hit the December 2026 quarter, and the company states the Texas fab is already ramping ultra-high-power continuous wave lasers, including a collaboration with NVIDIA. Multi-rail arrives in the first half of 2027, with a market above $2 billion by 2030, and it is already sampling. So, the business you are looking at today is running flat out at a record on none of its new products. Our take is that this is where the bull case actually lives. But I would flag the obvious counterweight, and I would flag it hard. 3 new product ramps landing inside 18 months is 3 separate chances to be late. There is a fight going on over how optics gets attached to the chip, and the market has been treating it like a coin flip. The company's answer is that it does not care which side wins. The deck gives 3 reasons. Content value is highly similar either way, because it sells the entire platform rather than isolated components. Major strategic clients are running both approaches in parallel, and the company says intensity has surged over the last 3 to 6 months. And the chief executive explicitly denied market rumors of delays in packaged optics demand. Now, credit where it is due, and I mean this. The deck prints its own caveat, noting that value equivalence is a management claim, and that outside verification of the exact dollar content is still obscured. A company that publishes the whole in its own argument is a company doing something right. So here is my read. I believe the direction and I cannot verify the magnitude. When a business tells you it is indifferent between two outcomes, that is usually true and usually a little overstated. This page is about time, and it is the kind of thing you almost never see in optics. According to the deck, 2024 through 2027 is fully booked, not forecast, and 2028 through 2030 is layering in right now through long-term agreements. Three features of those agreements matter. Volume growth is locked in year over year. Pricing is locked for the life of the contract, which the company frames as immunity to the optical price wars everyone is expecting. And there is take or pay, which means strict downside volume protection. The deck says customers are actively placing 2028 orders today just to hold their place in line. It is like putting a deposit on a car 3 model years out because you already know the lot will be empty. Our read is that locked pricing is a genuine defense, and it is not free. You give up the upside if raw spot prices ever spike. Management chose certainty over optionality. I think that is the right trade at this point in the cycle, but you should know it is a trade. Let's translate what management actually said, one line at a time. They said sales depend purely on capacity. Translation: the valuation anchor just moved from market size to execution. That is far more verifiable, and it leaves absolutely zero buffer if a factory slips. They said June laser output up 80% equals first quarter growth above 80%. That one is the tell. Managements only get that precise when visibility is absolute, because a specific number is a specific way to be humiliated. They said long-term agreement prices are locked for the contract life. Strong defense against a price war, and it sacrifices upside if raw prices spike. And they committed to $3 billion of quarterly revenue in fiscal 27. That last one is a public commitment sitting well above consensus, and it is incredibly hard to quietly walk back. Our take is simple. Management has deliberately removed its own escape routes. That is either real confidence or a very expensive mistake, and we are going to find out which. You can learn an enormous amount from what the analysts chose to worry about. The deck counts 18 questions across 9 analysts, and they clustered hard. 4 on co-packaged optics progress, 4 on margin trajectory, 3 on capacity, and the 6-inch wafer transition. Nobody spent their question on demand. That alone tells you the demand debate really is finished. Now here is the honest scorecard the deck prints on itself, the win. Questions on capacity and co-packaged optics got precise, verifiable answers like that 80% laser output number. The evasion. Bank of America pressed on the margin drop from the third quarter into the first, and management pivoted to operating expenses instead of addressing gross margin timing. And the missing piece. Management walked through exactly how it reaches 42% margins, then flatly refused to put a date on it. Pay attention here. A company that answers the hard question precisely and dodges the timing question is showing you where its own uncertainty lies. Alright, let's do the arithmetic nobody wants to do, because this is where the story gets tested. The fourth quarter came in at $2.05 billion. The stated target is $3 billion a quarter. The deck spells out what that requires. Roughly 10% compound sequential growth every single quarter with 0 misses. Then there is the margin bridge. Current first quarter guidance is 40.5%, the target is 42%, and that leaves a gap of 1.5 points. And here is the paradox the deck is honest enough to print on itself. Getting to $3 billion means spinning up brand new production lines for optical switching, co-packaged optics, and multi-rail. Historically, ramping complex new optics depresses margins first and helps later, so they need relentless sequential growth and margin expansion at the same time, in the middle of a factory ramp. To be fair to the company, the Wafer Transition is exactly the tool that could pull both off at once. But I am telling you plainly, I cannot call this one yet, and anyone who says they can is guessing. So what do we actually check in 90 days? The deck ends with 4 boxes, and they are the right 4. 1, the 80% promise. Did data center year-over-year growth actually clear 80% in the first quarter, the way the laser output implied? 2, the margin trajectory. Is gross margin closing that 1.5 point gap toward 42%, or did the new product ramps dilute it? 3, the timeline. Did co-packaged optics and PhotonLink officially hit the revenue ledger in the December quarter? 4, the wafer ramp. Is internal 6-inch indium phosphide output still on track to double by the end of 2027? The deck closes by saying the I-demand question is solved and the valuation is now exclusively a referendum on engineering execution. We agree with that framing completely. Alright, last thing, radar always leaves you a light. I am calling Coherent yellow. Not because the business is weak, because it flat out is not. The book is full through 2027 and the demand argument is over. It is yellow because management has priced in its own perfection. 10% sequential growth with 0 misses, and a margin target with no date attached. Here is what flips me to green, and I am saying it up front so you can hold me to it. If first quarter data center growth clears 80% and gross margin moves toward 42% instead of sideways, I go green, and I will tell you I was too cautious. If the ramp slips even one quarter, this gets a lot more interesting on the way down. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.